One of the things that I think was a tip off for me was that you didn't see wages going up appreciably, right? You did not see wages going up at the same rate as inflation, which I think is a little bit of a warning sign, because theoretically, you should see this kind of wage growth happening simultaneously. And while you've seen some, it's not as extraordinary as, say, the inflation that we've seen, with eggs up 57%, car insurance up 54%, electricity up 23%, for goodness sakes.
And Trish, this is why inflation is such a nasty problem, because when you think about what is the point of interest rate hikes and restrictive monetary policy, they kind of couch it in language like they talk about JOLTS, the job openings, and these metrics, and that there's too many job openings per worker. But what they're really talking about is, raising the unemployment rate, suppressing wages, right? Hurting the labor market, hurting the wage pressures on inflation. And that's the point of interest rates, to kind of hurt the bargaining power of workers. And they don't like to talk about it, but that's
okay. I know where you're going with this. And by the way, good to see Mike Costa's on here. We have a lot of familiar faces from the Trish Regan show. A little shout out to my other channel, but thank you guys for coming over here as well. Again, lots of familiar faces that I said, and plenty of people. Also, Kirby, great to see you here. Earl, great to see you as well over there on Facebook. But consider sort of the disadvantage, I guess, Rob, that everyday workers are being put. I look at what the Fed is doing, and I've said this for years, and this is not partisan. I've said this for many, many, many years. The Federal Reserve is very much at risk of, it seems like it wants to do the right thing. It says it's trying to do the right thing, but ultimately it only seems to be helping those with assets, right? So that's where that sort of capital labor equation starts to deteriorate. I talk about the middle class getting squeezed in an hourglass economy where you get handouts for those on the bottom and you got all kinds of upside for those on the top. And then the middle class gets squeezed. But the reason you get that upside on the top is because of what we're looking at. It's so inverted. You get news that, hey, you lost a lot more jobs than you thought you lost. And guess what? This means you're going to get interest rate cuts, which is beneficiary in a much stronger, bigger way to those with money in markets, which is why I will just, listen, I'm not going to get on my soapbox too much tonight. People hear that enough on my show, but 76research.com, code word dollar, you guys, DOLLAR. You can remember US dollar, right? Dollar. Go sign up for the 76 report, because it's just $1 a month for a couple of months, and it goes to $9.95, but you can try it out. You can cancel anytime, no cost. We'll refund your dollar, okay, if you hate it that much. But this is what you need to get started, because you got to invest. Otherwise, it's the Fed helping out the same darn people all the same darn time. And what I'm trying to do, and you're trying to do, and this is part of our methodology behind 76 Research, is bring more access to capital markets for everyone, right? So that everybody is getting somehow a cut of the action. But the Federal Reserve is not the middle class's friend, if you ask me.
Yeah, I think it's the friend to the stock market. It certainly has been the friend to the stock market over the last 20 or 30 years. And the stock market overall has compounded at levels that were above what people would normally consider the cost of equity or the expected return on equities. The stock market has outperformed, and we've gone from one sort of Fed-driven bubble to the next. And, every time there's a wobble or weakness in the economy, the Fed's right there. So I think you want to be on the side of, they say don't fight the Fed. I can interpret that in a longer term context of be on the side of asset ownership, because that's ultimately, the class of people who are sort of in charge and running the Fed and appointing Fed governors, right? They're all asset owners, with possible exceptions now, I guess, with some of the new politicians on the scene. But no, in general, it's a system that's really kind of relies on growth in nominal asset values, and that favors investors.
Yeah, I'm just looking at some of the comments that are coming in. Don writing, it's been 15 years of free money. Yeah, I don't know what happens when that ends, for goodness sakes. Peace of Mind asking an AI question. And you know what? We're going to get to that momentarily, because I know AI is on everybody's mind. NVIDIA, of course, being the stock of the moment. And Rob and I have some ideas on how to best play, if you would, the whole tech AI momentum, which is extraordinary. And I do so fundamentally believe in, and I know you do too. So we'll talk about that coming up. But, Mike making the point that if all else fails, you can certainly work hard to save your money. Like, I get it. But what do you do in light of all of this QE, as Don points out? In other words, QE is happening, right? And that's just the way of the world. It's the way of the sort of monetary system that we live with right now. And in light of that, it's sort of like, okay, you don't want to be the one fighting the Fed to the points that you just made.